My name is Michael Guyett, publisher of the Lead Lag Report. Joining me for the hour is special guest Danny Moses, who I'm sure many of you are familiar with. But for those, Danny, who don't know much about you, if they Google your name, I see nothing but things that say Danny Moses and The Big Short. So I kind of feel like
Right.
we should get a little bit beyond just the headline there.
Sure.
Talk about your background, what you've done, what you're doing now.
Sure. Everyone only wants to talk to me when the markets are down, so that's a running joke. So yeah. So
That's why
no, I mean I've been on
that's how I was scheduled this a month in advance. I knew
exactly
today,
right.
right?
Exactly. So I started working on Wall Street kind of in 1991 as a muni bond analyst. Became an institutional equity salesperson at Oppenheimer. Got to see kind of Henry Blodgett there, so I saw that piece. That's where I worked with Steve Eisman. He was the analyst for specialty finance, and that was subprime part one. A lot of people on this call probably aren't old enough to remember kind of the subprime auto disaster and home equity loan disaster of 1998 and 1999, which actually was a prelude, to what happened later, obviously with the tech bubble. So I saw that, and then I was fortunate enough to get onto the buy side, and Steve Eisman hired me, and I worked with Vincent Daniel and Porter Collins, kind of as their trader. Eventually became a partner with them, and obviously by the time I got there, I had worked at another brokerage firm called Friedman Billings and Ramsey, which literally built the Trojan horse for subprime. They created all the companies, so I saw the sausage being made. Got to the buy side in time to short everything that they had created, and obviously the rest is history. I'll say one other thing. I'm big into market structure, which sometimes I speak on that. And when the Big Short book came out on March 14th, 2010 or 15th, whatever. Remember, the flash crash was May 6th, 2010. The flash crash was May 6th, 2010. And so soon after that, I called Michael Lewis and I said, I think I have something else for you. He was like, no one tells me what to write. Ha ha. Anyway, the next thing I introduced him to Brad Katsuyama and Ronan Ryan at IEX. And then there was a book, Flash Boys, that was obviously written. And I make a small appearance in that thing as well. So just as a way of context. So it's not just about shorting housing bonds. I'm very into kind of the market structure underbelly of algorithmic trading and how bad that is also for the market. So just add that negative piece on there too. And then for the last kind of 4 years, 5 years, I've been doing kind of independent investing, advising, dealing in every sector from biotech to cannabis to fintech to anything. So, I've been out of the kind of the daily grind of money management. And I would start with this is that this is the first time I think in the last, well, not a coincidence, first time in the last 10 years that stock picking is really coming back to the forefront. And so I'm getting more active, I should say, trading than I have been in the past. So
Yeah, no, so there's a lot to unpack there. Okay, so first let's talk about that market structure of old versus now, right? Because back in the good old days, you'd have a specialist, you'd have some kind of middle person,
yep.
and you can argue that there was maybe a more orderly functioning type of bid ask mechanism that obviously all got replaced by algorithms and the machines. Talk about how the advent and acceleration of algorithmic trading has changed market structure over the last several decades. Has it made it faster? Has it made it more treacherous? Talk about how the dynamic has altered over time.
I think it's really changed the way that investors behave, getting caught up in the movement of pennies as opposed to quarters, right? And so when you think about the old days, when I was trading the old days, I'm a big fan of high touch trading, right? You call your broker, you say, I need to move 300,000 shares of XYZ. You trust that they're not going to stick this thing into a machine or make a bad phone call to a potential person that would front run you. You mean in a perfect world, they put up a little bit of capital, they get you done, within a reasonable expectations, call it, 10, 15 cents was a good fill on a $20 stock if you're trying to move, decent piece of volume. Anyway, with that, you would get a lot of color and you would understand that you would get a feel for the market. Oh, there's a seller down there. Maybe I should wait to buy some, or there's a seller there, maybe, or a buyer, maybe I should wait to sell some. That to me was kind of the behavioral finance aspect of that aspect of playing poker, of trying to read the market, which I truly liked. What happened was the brokers and all their greed, obviously, with help of the exchanges, obviously, it wasn't just the brokers able to do it. They started to create dark pools, right? And with that, we saw the advent of penny trading, so to speak. And I think with that became, brought in a lot of people who were trading for dimes and nickels, getting in and out of stocks versus people that really cared about fundamental bottom up analysis, like you and I wanted to trade stocks for 30%, not for 1%. And I think it had an impact not just on the plumbing of the system, and I'll get to that in a second. It had an impact, I think, on market psychology. And what happens is, and still happening now, is that I think portfolio managers get caught up in these swings in these stocks during the course of a day, And yes, there might be news out on some of these stocks that are creating the volatility in the move, but they're getting exacerbated by what's going on in the algorithmic program trading world or in the HFT world, however you want to call it, in the payment for order flow world, whatever it might be. And, retail investors tend to play that off as, well, it's a penny here, a penny there, no big deal. It's free trading, it's commission. I disagree. I think the impact is you can't measure this, but the impact is I've missed it, it's going up, I'm chasing. And the flip side of that is I've missed it, it's going down, I'm selling. And what happens is a wave of orders all come in at the same time. So your order may be 100 shares on the retail side, but there's 10 million shares that are all moving in the same direction. And I won't name the big firms that are out there, buying the order flow, but obviously this creates kind of a false narrative in terms of how a stock, and then the stock takes on a life of its own. And before I get too deep in the weeds, I'll just say that in turn then has an impact on the institutional investor or fund manager who may not even realize there's no news on the tape, but sees the stock swinging a certain way, and then they make a move. So it really feeds on itself, and really we have many flash crashes every single day in every single product, in bonds, in equities, right, in commodities, in everything we see. And that really is a result of where we've kind of gone into this dark world of trading and the lack of high touch trading that's been out there. So, long winded answer. I don't know if I answered your question, but there is no one thing. And listen, I'm a big fan of IEX, right? Because I believe in fair trading, and you shouldn't make money because you have the fastest speed, right? I mean, let me just say this. If you ran a biotech company and you were CEO and is publicly traded, which you don't, and you had a cure for some type of disease, and you told one of your friends about it, that you were going to be announcing this, which you wouldn't, because that would be illegal, insider trading, there's a 99% chance when that news comes out that stock goes up, right? And you brought it, you front ran it, you broke the law. Well, how about a 100% chance of always making money if you just had the fastest connection on a router, right? In one of these data locations. Anyway, you got me down. I could go on this, but it does create an unfair world. No one should have that type of advantage. And what it does is I think it spills over into the psyche of these investors, and has an impact. So
No, and I will say it adds this kind of perverse incentive also. So I was smiling as you're talking about this because I've made this point on the road myself at CFA chapter presentations I do, that what's happened with commission-free trading and this complete decimation of margins in that's causing spreads to be so tight is that it creates this false sense of confidence that you can get in and out easily at no cost, with no friction, and it results in a messaging campaign by the major brokers to basically encourage over trading, which becomes very problematic for those who are not rules based, makes them underperform over time, and creates these kind of liquidity vacuums,
let me just say
like
this.
you
Yeah,
mentioned with the
no,
splash crash.
I told you I was sitting on the trading desk with at Front Point, and these salesmen would come in from Credit Suisse and Citi. And this was like when the dark pools were kind of coming in into favor, and so this is right around the flash crash prior to it. And they said, "Are you enjoying the trading for 2 cents and 1 cent?" Liquid net would come around. I'm like, "Yeah, sure, it's fine. I was using it." They go, "Tell you what, we're gonna cut your commission to zero." I go, "Really? You're gonna cut my commission to zero?" Right? So who's the sucker at this table that I'm sitting around? I'm going to trade for zero? No, they were trading against our flow in the dark pools. They had prop firms set up, as you know, it's come out. They paid all these fines. I mean, people forgot Schneiderman, before he got ousted, was all over these brokers for what they were doing. They had set up these funds to trade against your institutional flow. Here you were, a client of these firms, a big client of these firms, and you were being taken advantage of. So again, there was so much to this that went on. A lot of that stuff is still out there to a degree. There's 8 books been written about dark pools. I mean, there's been plenty of books that have been written about it, but no one cares about any of this shit in a bull market. Let me just say that, or about anything in general. No one asks questions in a bull market. So anyway,
Yeah,
yeah.
no, exactly. And I was also, I mean, the thing about algorithmic trading and the move towards that across the board about structure is that every algorithm is basically a regression based on some observed relationship. And it's not like these are hidden relationships. I mean, you do enough testing, pretty much all these algorithms to some extent are chasing the same historical anomaly, which is what creates these, again, these vacuums, right, that
Right.
happen because they're all looking at the same stuff, right? They're all trading off the same equations to some extent, which I think is, to your point, underappreciated, and that only matters when you need liquidity. And that goes into sort of a different area of the discussion, which is what really does set price, right? So I've used this line before that it turns out in a world of so much liquidity, it turns out you don't have it when you need it the most because it's
Correct.
always the marginal seller,
Yep.
right? That really sets the price. Talk about liquidity and market structure in this environment, because we hear that there's so much liquidity in financial markets because of the Federal Reserve and because we see it with inflation, but is there really that much liquidity when it comes to underlying trading? Let's talk about that for a bit.
Well, it depends. I'm not moving blocks of stock like, I had in the past, so it's hard for me to gauge that, exactly. I used to watch, I'm sure you know this and you probably still do it, but when you see a large trade hit the tape, like a 200,000 share block on a stock that trades maybe 1.5, 2 million shares a day, it'll have an impact on the rest of the day on what we call VWAP, right? This volume weighted average price bullshit that people kind of use as a target. That's how traders were trained to trade, like Fidelity and Wellington. They just had to, quote, beat the VWAP. Well, to the point, it's like a self-fulfilling prophecy to beat the VWAP if they're the largest volume amount. So these machines have a way of figuring that out rather quickly. As far as how much liquidity is in the market, you just said it best. It's not there when you need it, right? It's there when you don't need it, and when you really need it, it's not there. And so that, I think, is a standpoint of being active trading, stock picking, being willing to be early, being willing to be late, whether it's on the short or long side, right? Whatever it's got to be, and picking your targets and staying with them, and not get caught up in this. Oh, I missed it. Here it goes. And so I think that liquidity, while there's a lot of shares that trade, a lot of them are just BS trades that are redundant. And the true fundamental trading, who knows what percentage that is, 20, 30%. I mean, we've seen this whole Robinhood iteration kind of come and go. Maybe go is a too strong a word, but we can see what's happening with that platform and the trading on it. Um, and that volume is going to start to come out of the market, obviously. But there's just difficult ways to measure what real volume is. And the other thing is that when these HFT firms, the payment for order flow, and just the retail brokers use what we call price improvement. I hope anyone on this phone that thinks that you get any price improvement, you realize that that's a fixed game also, and that's measured against something that you can't lose against. So anyway, there is liquidity out there, I think, for plenty of liquidity for longer term investors that have targets that are outside the bands of 2%. So leave it at that.
Okay. So
Yeah.
let's a couple things. So longer term investors. So I would argue that the definition of long term has changed quite a bit
Yeah.
in the in the last
Yeah.
several decades, and partially that's related to, again, the temptation to trade because commissions are lower and spreads are tighter. And there's also an aspect of the media which encourages, a degree of action, right? Because everybody always is a momentum whore, right? I mean, that's just
Yep.
the reality when it comes to this stuff. Um, how do you think time frames in the way people look at their own net worth? How do you think that's altered market dynamics here? Because again, it used to be the case that people, when they would invest in a mutual fund, for example, they'd hold it for a few years. Now I think the average is like 9 months. Forget about with ETFs; it's even worse.
So if we're talking about retail, I guess that's what we're really talking about. The gamification of the markets, which has been taking place, really since even prior to the pandemic, but exacerbated during the pandemic, right? And then all of a sudden, DraftKings and FanDuel get approved almost in all these states, right? And there's crypto trading. We don't have to talk about that. I know that's not the topic of this, but for the most part, with the DeFi and the coins and the bullshit that goes on, it's just gambling to a degree. It's the same thing. It's just, no, I wouldn't say Ponzi scheme. In some cases, it is. Ponzi scheme is just, all right, where is the wave coming? What is the retail crowd saying? And by the way, I think every institutional investor underappreciated the power of not just Reddit, right, and the Wall Street Bets crowd. They very powerful, and that really came together during the pandemic. And I mean, I don't have to tell you the funds that have gone at the institutional hedge funds, which have gone out of business as a result of getting caught on the wrong side of a short squeeze or something. So I just think that retail investors they have the opportunity to, you know, educate themselves, but I think they're getting dinged up now in so many different things that I'm scared that they're never going to come back. So to answer your question, I think there's over trading going on. I think it's all momentum, meme stock, story based. Not all, but many of these are just based on nothing. And if you're trading a company that is nothing more than momentum and not based on fundamentals, you will lose. I mean, that is gambling. You will end up getting caught because people that use the mentality of, oh, if I just get back to even, I'm going to sell. And that's the worst thing you can do in trading. That's an opportunistic, cost, right? That's an opportunity cost of capital that maybe you could take that money and stick it into something that maybe will take 3 years to go up 25%. But to your answer, everyone wants immediate gratification. That's what this market has been about. That's how it's been trained for the last kind of 3 years, right? I can go into social media, getting immediate feedback, and I think people get so caught up it becomes cultish in a way of that they take it personally that they feel bad about themselves or they feel great about themselves. And I go to the casino for that for a period of time, and I try not to do that in the market. So there's a massive market psychology unwind which we can talk about later, which is going to have an impact, I think, on on the overall stock market for sure, sentiment wise. So yeah.
By the way, you mentioned retail, and I deal with a lot of advisors, and I have to tell you unequivocally, advisors are in many cases no different than the underlying clients that are retail. I mean, they are in some ways worse because they fall for a lot of the same narratives that their own clients do, and then they're on top of that getting that constant reaffirmation, confirmation bias that their belief is right because the algorithms, which we'll talk about, keep pushing in front of them things that they already agree with. Things are going to keep going up. Oil is going to stay down forever, right? All this stuff, which we'll talk about. Let me
You know
get
what?
John
Yeah,
on.
go ahead.
Yeah, go ahead. No, go
No,
ahead,
I,
David. Go ahead.
no, I was just going to say the whole broker mentality changed when they changed how they got paid. So I'm sure most people realize out there, the old days, you would have a retail broker that would charge you $69 for a trade or whatever it was. And then they would get paid by the mutual fund, these fees, right, to push the mutual fund. So they go to a Morningstar golf outing. The next thing you know, you're being pushed Morningstar mutual funds. But it's fine, whatever. That went away. So then now most of these brokers run these managed accounts where they charge, let's say, 1% of the assets. They don't pick stocks. They're all ETFs. And I was just going to say that people believe that they're safe in these ETFs, which are all these stocks are correlated to each other. That's horseshit also. So that's where I think the brokers have really dropped the ball. Is, oh, you want some financials? I'll stick you in the XLF. Oh, you want some retail? You go in the XRT. Makes their life easier. And then when a tough market like this comes for the first time in many years, they have to start doing their job again. And there are some good brokers out there. And I'll just say this: I use some of them. Some of them are friends of mine, and I think they're really sharp. I go, "What kind of calls did you get today?" Oh, I got a call from three guys to sell all their PayPal. I go, well, are they down in it? Oh yeah, they got killed. All right, thank you. And then I go buy it myself. I'm like, I'll go. That's a sign to me. So use those people for psychological, endpoint, so to speak, is how I use brokers. Anyway, sorry.
Yeah,
Yeah.
no, spot on, spot on.
Yeah, well, shame on the regulators for allowing the advent of some of this stuff, and then finding Robinhood later about what they were doing, not providing, to your point, the right information, giving trading tools to people that never should have access to them, whether it's an option account, not even knowing what they're doing. I mean, there's so many levels of this that I think are crazy. And you think of FINRA, well, that's run by the industry. I mean, so they don't do anything to anybody. And anytime that regulators do anything, it's in reaction. They're not proactive, they're reactive to this. And so it's way too late. I mean, when I saw the Robinhood app launch and I saw the confetti, congrats on your first trade, and giving out free stock for doing this and this and that, I'm like, holy shit. I mean, I could go back and blame it on the
That
Fed.
was a massive red flag. I'm with you.
Yeah,
I had the exact same thought on that. Yep,
exactly. So when I think
it's
back to
insanity.
like, and I blame it all on the Fed anyway, but that's fine. In terms of printing this money, money was just is so free. I mean, money was so cheap. So anyway, it's natural. I saw this in 2000 and 2001. It really was the same thing. There was Yahoo chat rooms. It was very similar. Stocks weren't trading on fundamentals. Someone was always left in this Ponzi scheme of holding stocks till the end. And that's why I just tell people, if you're buying a stock without fundamentals, just on hype and just because everybody loves it and has momentum, and you see these. I mean, I go on these boards just to read it because I want to educate myself, and I am literally, I get upset. I get upset because I know what's going to happen. It's inevitable. There's not a chance that these stocks are going to work over the long term. And as a short seller, sometimes the best thing you can do as a short seller is go find these people, or even a real fundamental long person who believes they see something in a company. And the flip side is true also. If you're long, go find the short seller and find out what that story is. And I'll say that it's been so one-sided on those platforms in terms of just incenting you to do whatever you can to keep trading and doing, and it's devolving. It's not evolving. And listen, it was E-Trade in 2000, right? 98, 99, 2000. This happens every iteration. I just think when you're in the moment, it feels like it's the biggest thing to ever happen. But everything's real. It certainly rhymes with stuff we've seen in the past, just on a much larger scale, with all the connectivity that's out there and technology that allows this information, even if it's false information, fast. But answer your question, it's way too easy to trade, right? And I think that people that have gotten into the market have no understanding of anything, and they don't have to understand what a price earnings multiple is. They don't have to understand all of that, but just the basis for like investing in general, they don't. And if you don't know the rules before you get in, forget it. I mean, then you're really against it. It's one thing to not know what a company does. It's another to not even know how to trade. And so, yeah, hitting a big buy button and getting confetti thrown at you virtually, not a great concept.
And it's remarkable because if you were to look back at a lot of these tweets from all these different accounts last year, it was so obvious. I said that back in February. It's like we're going to look back and say that all this insanity with crypto and all this insanity with emojis, right? Like I'm sharing the one with diamond hands and
Yeah.
rocket ship and all this, to the point where it actually became a commercial. I think it was E Trade, right? So with the astronauts on the moon, to the moon, right? Whatever is that commercial. It got to a point where it's like this is like classic, and I've used that argument that it's amazing to me that the Fed didn't see that, right? Because that was a clear sign. This uneducated speculation you could see happening all across social media. That was a clear sign they had to start pulling liquidity back yesterday because that uneducated speculation comes from all of that stimulus from the Federal Reserve.
Correct. It was a lag thing that they didn't see coming. But yes, you're right.
Right, exactly right. All right, so let's get into kind of the name of the space here, right? So stock market worse than '08 and 2020. I've said that
I didn't
many
title that,
times.
by the way. Is this your
No,
title?
no, no.
Okay,
Right,
because
yeah, no. So I've used
okay.
that line before, and I say that because first of all, bear markets make fools of both bulls and bears.
Yep.
Right, because it's about volatility going both ways. But I've used that, and I've made that argument because unlike in '08 and 2020, diversification for the most part mattered. And what I mean by that is if you take out the commodity and energy space, for the most part, this year has been horrendous because let's call them classic diversifiers, those real risk off plays, really talk about treasuries. They just haven't worked, right? In 2008, post Lehman, treasuries hedged a bit, but they really kind of rocketed November, December. In 2020, in the midst of the COVID crash, treasuries were the only place to be. You don't have that here as bonds are correlating with equities. And I think that makes the asset allocation decision and process very difficult. I want you first, Danny, to talk about from your experience. How do you actually think of and define what a crisis is? Because that term is thrown around a lot. And then we'll get into some of the similarities or differences from prior periods.
Yeah. So just I wouldn't compare anything to 2008 in the sense of the lack of understanding of how bad these balance sheets were at the banks and how unsafe it actually was, and what the systemic risk was and turned out to be. Even us, in our as bearish as we were, and being short some of the big broker dealers that we knew were holding some of these mortgage back, we didn't even believe that this could happen as bad as it was, and how it spiraled. So I would say the first thing is that moment in 2000, the Lehman Monday after the weekend, when Lehman actually says basically we're out of business. That was a very scary day for people that weren't even bullish or bearish, because there were your Lehman was effectively, for people that don't understand, these brokers are the banks of these funds, and so all of a sudden that was a crisis because you couldn't even locate. Think about having your money in a bank and the bank just shuts down with no FDIC guarantee or not even knowing what was going to happen. So that's a crisis. And this time around, just to bring it back here for a minute before I go back, we don't have that this time. This is just, I'll go to your point in a second, but this is just, kind of a market that had too much money chasing too few things, that was looking for a home because the Fed kept printing longer. And we have not yet dealt with the aftermath of the financial crisis, because if you remember, when QE1 started soon after 2008, or in 2008 to early 2009, we soon followed with QE2, QE3, and then obviously COVID created QE4. But we cushioned the blow, so we never really found clearing prices of things, of hard assets, right? And even it took a while. I mean, stocks will find their way to their rational price over time. But now, if you want to fast forward back to now again, because the Fed is actually pulling liquidity on a sustainable basis for the first time, raising rates in combination. We saw this a couple of years ago. They tried it, didn't work. But this is like a true big unwind from 9 trillion. Now you're going to see a little bit of all of that come back to us. And that's why I'm more nervous. I don't consider a stock market going down potentially 40% a crisis. It's bad. It's a bear market. It can feel like a, depression, but I don't call it a crisis. It's a crisis of confidence because no one knows where to put their money. And I'll say that at the same time, with inflation running where it is, we haven't had to deal with something like this to your point, at the same time, which is actually creating yields going higher and bonds therefore selling off, and there's nowhere to hide. That being said, you got to use these yields and use the information. And you just excluded energy, but I would say, when everyone hates a sector, even before oil prices were moving up sustainably higher where they are now, everyone wanted an excuse to not own energy. It got, at one point, it was like 1.8% of the S&P. I know historically it's always been a little bit higher. It's never, it's gotten up to 10, 12, 13, whatever. So people have to stop thinking. And the reason that is because you can't make a lot of money in energy in the course of an hour or a day or a week. You have to actually plug in your models and put in price of natural gas, price oil into it. So to your point, when people don't want the people that are trading just fast money around, there are opportunities out there. And let me just say this, like the advent of certain products like buy now, pay later, which I changed to short now, cover later, late last year. Those type of things, when you see companies that are able to create a business model on something like it, you cannot commoditize lending, right? You just don't. If you're Vinny always used to say this, if you're growing your revenues faster than GDP, you are going to have a credit problem. So there is a credit issue right now, but it's not going to take down the banks, right? There's a issue with oil here that I don't think anyone could have seen coming in combination with all the things that are going on, which is bad. So I don't think I answered your question, but we are in a we're in a reset mode, kind of a come back down to earth mode right now, and it's going to be painful for a lot of people. And with inflation running at really 14-15%, even though it's reported at 7 or 8, the reason I think the stock market is holding in here, I really do, and why the good names I think are getting overbought or seem rich, is because where else are you going to go to get any type of return, right? So I think the stock market can have an inflationary aspect to it, and I think about things like that, like, so it's an asset, right? So anyway, I don't know if I answered your question, but every
No, that's good. But
yeah,
no, but I will say, but real quick, I will say, but there's one commonality in every crisis, I would argue, which is that there's usually excessive leverage, right? That's the condition for something to happen, right?
right.
So it may not permeate in the same way, but you can make an argument that leverage is obviously much higher than it was back in '08. So that could make things even more fragile, even though it's not emanating
So
from the same source.
yes, it's a great point. So the leverage isn't sitting necessarily on the big banks this time, right? It's sitting on company balance sheet and maybe consumer balance sheets to a degree. And you bring up a good point, because I don't know the exact number, but I think $1.8 trillion of high yield bonds were issued last year, if I'm not mistaken. It was some trillion. You think about all the bonds that are out there that are going to be coming up for reset. I said this on the podcast that we do on the tape a couple of weeks ago. When you start to look where you want to start putting your money, start to look at balance sheets of companies, right? That have cleaned up their balance sheet. If they took out debt 2-3 years ago and it's 3 to 5 year paper, you've got to start to factor that in, because they're going to be paying double potentially the rate that they were. And that's all part of the price discovery in bonds and the price discovery in stocks. And there's been neither that have occurred for the last 13 years, because the Fed has had your back and they've been printing money. So you bring up a great point. And yes, and I don't think a lot of investors have had to deal with that for quite some time. They're seeing it personally on their mortgage rates, but as far as analyzing a company and what their balance sheet looks like, I mean, Macy's did the right thing, right? Macy's took the time to pay down their debt. I don't own Macy's, but I'm saying, like, you want to see a company that got the joke, that's in a decent position, probably, and I think that's why the stock's acting well. Anyway.
And that's an important point. I'd say I always go back to that point. No amount of intelligence increases the clarity of one's crystal ball.
Yep. Trademarked on that? Did you trademark that?
I,
Good, good.
I might have
All
to.
right.
Now
All
I know
right.
you got the capital to trademark. So I'm going to do it for you. Sorry, John. Go ahead. I didn't mean to interrupt you. Go ahead, John. And let's go with that. Let me turn that into a question for you, Danny, because I think this is a question you often hear, which is like, at what point does the stock market change the Fed's direction? My view has always been that it's not about the stock market; it's about credit spreads. And the problem is that you can't really have the Fed change direction unless credit spreads blow out, default premiums really skyrocket. You can't really have that unless commodities break, because a lot of these junk debt issuances are very levered commodity drillers and in that space. So let's kind of go with that, just to kind of keep it focused on sort of a specific question there, Danny, if you want to kind of riff on
Yeah,
that.
yeah. I think it comes down to what risk rate or discount rate do you want to apply to a company's future business. So, the way you would do it normally in fundamental bottom up analysis is you project a company's earnings out 3 to 4 years. You apply some discount rate to that, should be maybe 10-15%, but people have been using basically 2, because they don't measure risk, because the Fed's had our back, and they discount that back and they make a decision on, is this a fair value for a company? So as risk grows within the industry, and to your point, credit spreads start to widen. And I would say, again, for people out there, credit always leads equities. Credit spreads were widening 5 months ago in various categories. They were already out. We saw late payments were going up a little bit in consumer credit. Delinquencies were starting to trickle up. And you saw when mortgage rates started to go, those spreads were widening out dramatically. So anyway, people were already anticipating what the Fed was going to do. So things have to be just reevaluated. And this is what we're dealing with. Again, for the last 10 years, you really haven't had, on an overall market basis, have to really care about risk, because you know what? We're trained. The market goes down. Good old Bernanke, when he was there, we'll just print. He reacted to the stock market. And to your earlier question, Powell's making it perfectly clear with this administration that it's inflation first and stock market second. Previous administration was stock market first, wealth effect. We didn't have to deal with inflation, so there was no inflation second. There was nothing, but that's how it was. It was driven by that. And I think you've seen now it's not a Fed. It's a it's a market put, not a Fed put. Meaning every time the market's up, you see a Fed governor come out to take a chance to reiterate, to hammer home the point that they're going 50-50. They're not stopping. I mean, Lael Brainerd coming out and saying, I don't know what Bostic from the Atlanta Fed's talking about September. We're a go. We're a go. So I don't. I think the Fed has misjudged this entire process from the very beginning, before Powell, to Yellen, to Bernanke, right? All this stuff is they're dealing in uncharted territory. And for Powell to say a couple of weeks ago, yeah, we're going to start quantitative tightening. I'm not sure what's going to happen. I think it's the equivalent to a quarter point Fed fund rate. Bullshit. It's much more. And the reason it's more is because if I'm a dealer on the street or I trade mortgage backed securities and I know the Fed not only is not buying mortgage backed securities any longer, forget about treasuries. What am I doing? I am front running my way out of there. And that's why mortgage rates went out. So you're talking about financial conditions, right? As those deteriorate, those will wake the Fed up, right? To the point that was just made by Michael. So those will wake the Fed up. So do I think the Fed goes to 250, 275 in the Fed funds? Absolutely not. I think if I had a CME account, I would be betting Fed fund futures to move sustainably, well, higher versus lower, whatever, however we want to call it. I think we're going to end up with maybe 50 coming here in June. They have to for credibility. And I'm not even sure if it's 50 coming in July. And that's because I think that the demand destruction, I mean, we've only raised 75 basis points, right? That's all that's happened so far. But I think oil is doing a lot of dirty work. It's two-sided. It causes inflation, but it also slows down the consumer. And I said last night on our podcast, I said, I don't even know what the jobs forecast number was today. It was the first time I hadn't looked at it. And the reason I didn't, because I'm not going to use it as a tool to what I think the market's going to do. Because if it's better than expected, you'll hear arguments of, oh shit, the Fed's going to go more. The bullish argument would be, see, I told you the economy is still strong. And you get the flip side of it, right? Which is the Fed's going to keep going. So I don't know. It all comes back to if you take I don't know, Michael, I don't know if you tweeted this or not, but I saw it recently. I think it might have been you. If you look at the Fed's balance sheet and you correlate it to the S&P, you can't see the difference in the two lines. And so
Yeah,
don't fight.
right. Which goes back to the uneducated speculation because it wasn't because of genius you were making money. It was because the Fed was doing it.
Right. Don't fight the Fed both ways. Don't fight it on the way in and don't fight it on the way out. That's basically it. And so to your point on Zoom, I haven't looked at it. There are stocks out there that are going to be cheap. They're getting thrown out. That's opportunity. And people always say to themselves, oh, if that stock gets to $15, I am buying the shit out of it. It's sitting at 22. It gets to 15. They're running. No one buys it because they're like, hold on. It actually got to where my buy point one. So discipline is really key in this. And if you listen, if you have a 3 to 5 year time horizon and you buy a quality company, you're going to be absolutely fine. So I don't want to be too bearish here. Yeah.
Yeah, and that's important to emphasize too. And everybody's here. Please make sure you follow Danny and check out his podcast with risk reversal himself, Mr. Dan Nathan. So okay, hold on. Now you threw out the word risk, and risk is kind of a funny term in this environment because everything seems to have tail risk now. And I've used that line before that there's no such thing as a store of value. The Federal Reserve, ended that with ZIRP, with zero interest rate policy. So everything's got
Here it
tail.
comes. Here it
Right.
comes. Go ahead. Yeah. Keep going.
And
Yeah.
and like even in my world, right? Even in my world, when you talk about, I brand myself as a risk on, risk off manager. I've got these different research studies. They're back tested, quant based, and all this stuff, and that are variations of risk on, risk off type of investing, all in equities or high yield, all in treasuries. So risk on is equities. Historically, risk off tends to be long duration treasuries. You get that flight to safety, yields drop. And we've seen risk off has risk, right? Treasuries have gotten smoked in this, which is one of the reasons, if not the primary reason why in the way this actions played out. So this kind of lends into a little bit of a discussion around how people should think about risk and diversification. Because if we agree that there's no such thing as a store of value, that means you can't be all in Bitcoin, you can't be all in any cryptocurrency, you also can't be all in oil and commodities. How do you think about risk in an environment where seemingly there's nothing that's safe?
Well, I think there are certain things that are safe, but let's just go after the last comment you just made that crypto is a store of value. I mean, has it been around long enough to even qualify that it stood quote the test of time? I mean, I have a real problem with Winklevi twins with their comments last night from Gemini saying this problem we're laying people off. It's been exacerbated by macro uncertainty and volatility. I'm like, that was the whole crypto theme. The whole crypto theme was that we benefit from all of that because we are, we're away from the government. We're not affected by policy. Anyway, let me get that out of the way.
Well, no, first of all, narratives change based on price.
So
Right, and that's fair. And I think, and just continue with Danny's point on that. And I think that's fair. And I think, for me at least personally, when I rant on all these terminologies, it's because I find narratives to be very dangerous because it causes overconfidence, causes leverage, causes the crashes, rinse and repeat. While other people who are very wealthy can say these narratives, and they can say it because they only own 2 or 3% of their net worth in it. Whereas others, larger, that's where I have a problem with it. But anyway, Danny, sorry, I want you to keep kind of going.
No, I was going to say I do think gold, and I'll move on from gold, but yeah, gold's not exciting. Maybe it's not sexy. It's been between 1,700 and 2,000 effectively for the last year. But you think about, I mean, there's not a lot of certainty in this market, but I do have certainty in one thing. I'll probably be wrong. There's no soft landing coming. Okay, it's not happening. Um, and if there's no soft landing coming, I can see gold at worst case being flat, right? You pick a gold miner with a great balance sheet. I don't care what it is. Pick something in, within the gold sector, because I am shocked at this point, especially with the recent failures in crypto, that gold hasn't really found its footing. It's hanging out 1860, 1870, but you could paint a lot of scenarios where gold is going to explode higher. I see very, very little downside in that asset. So I will tout gold.
By the way, Danny, on that point, because I think it's an important point too, is that I would actually argue that gold's done exactly what it should be doing, which is that, and I've done a lot of studies on this too, and there's other studies that back this up, that gold really doesn't correlate to very much, except usually high volatility periods in equities. It's why I have gold as the denominator for lumber to gold, right? So that's the whole idea of lumber to gold. Gold's a risk off asset. Treasuries tend to be better, but the other part of the gold, which I think is really not talked about, which is not sexy, is that it's the ultimate diversifier because it's not really correlated to anything.
And it really is affected by the dollar, right? Because gold, right, most part of the world is dominated, dollars is how it's traded. So it is impacted. So when gold has been hanging around here, it hasn't gone up because the dollar has been so strong. The dollar's recent weakness, though, you see where gold's actually catching a bit. I won't talk too much about gold, but I will say if the Fed blinks and people get what they want, the best asset you can own at that point is gold. And if people believe that the Fed has lost control on the inflation, the best thing that you can own is gold. And that was always the narrative prior to crypto existing. Anyway, let's get past that. As far as what you can own, things that have decent yield, there'll be a lot of decent corporate bonds if this thing continues that, will widen out enough where you can capture, 5-6%. I realize that's under inflation. I like utility stocks. I've been saying that for a year and a half as a safe way to, regulated industry, obviously safe way to capture yield. But, again, Mike, it comes down to the whole mentality of how the retail investor has been brought in this market for the last 3 to 5 years. The expectations of returns, that's where the narrative that has to change. And market will always be around. And that's what I love about it, right? It kills everybody. I mean, pigs get slaughtered, bulls, bears, everybody, it humbles everybody. But that's what I like about it. And you can have an opinion and you get punched in the face. I mean, you're always, listen, if you're short a stock and you're right, you're always going to be early, right? And so I guess my viewpoint is fundamentals over a long period of time will play out, and that you can control. And your money management and your opportunity cost, to what I just said before. If you're in a GameStop right now, sell the thing. I mean, what are you doing? Why? Because they're launching an NFT marketplace. Because look at the technicals of that thing. You can't even borrow it. Okay, so maybe it won't go down near term, but when that comes available, it's going down. And I'm using that as an example because people are following Ryan Cohen around. Oh my God, the guy's a genius. He ships dog food at a loss. Guy's the greatest thing. Oh, he took a steak. Oh, he talks about sitting on the toilet. The guy's, I've had it with all these guys, the Musks of the world, the Ryan Cohens of the world, the demagoguery that has come into this. Now you got me running, Michael. So you got me all hot.
I got to tell you,
So
any
please, I don't
well,
even.
No, but hold on, but I don't want to make this like a dumb fest on individuals.
No,
but I think your point is right, and I use that line continuously, right? There are no gurus; there are only cycles. There are no fucking gurus. There was a time in my life when people saw me as a guru in 2011 when I said there was a summer crash coming because certain indicators were saying the conditions are there for an accident. I was a guru in 2020 when was in treasuries prior to the COVID crash. Oh, and then everyone focuses on Cathie Wood. And I always made it a point that it's not about me. It's about the cycle that I'm operating in. And the problem, unfortunately, is that that's not a sexy narrative because people want to go to the soothsayer on the hill. And the problem is that only works until it stops working.
By the way, point in fact, from a marketing game that this has been for Kathy Wood, I give her credit. She's a marketing machine. I don't know who's out there raising money. She goes out and does it. She had inflows in her worst, in the last few months, right? You've seen net inflows.
Kills me, Danny.
I'm
Kills
like,
me
how
because
is
it's
that
like
even? What am I missing? Where is that coming from? Who is
yeah.
who is feeding that to her? Anyway, just end with that. But
No, and
listen,
I'll tell you even
yeah,
first, like that kills me because it's like, I'm an entrepreneur. I've got these funds. I've got rules based approaches. I'm very open and out there, and I market and try my best, talk to as many people as I can, and yet I see, it's the loudest voice that always gets the biggest audience, and I think that's so unfortunate because it has nothing to do with the content. It's all about who's saying it.
yep.
That to me is what's I think at the core problem with the investment industry itself. The
I
industry,
agree.
not even talking about investor behavior.
There's a lot of propaganda to your point that's out there that needs to be. It's just smoke and mirrors, nothing
Right.
more.
Exactly.
So
Exactly.
honestly, people don't change. They're going to take credit for themselves when the stock goes up. They're going to blame you when the stock goes down. You can
That's
just be,
that's the disposition effect, right? I think,
yeah.
or
I just,
self attribution bias, right?
I just wish people would understand, the market psychology, but it's so hard to see when you're in it, right? And I tell people to read, like, I know it sounds boring, whatever, but The Rise and Fall of Long-Term Capital When Genius Failed is the best book. It's better than The Big Short. I mean, it's the best book ever written about humility, arrogance, and it teaches you really how people view. The other one is Livermore. Every, Reminiscence of a Stock Operator. Like, you start to read those, you can start to understand, and people can see these cycles. And I'm fortunate or unfortunate enough to have lived through several cycles. I mean, I was, in 1987, and someone just asked the question that they were around, and I was in college, and my dad called me, goes, "You need a job," and that was my first iteration. The stock market can hurt you, and I was umpiring softball games at Emory University. Anyway, and then '91, trying to get a job out of college in a recession, seeing the dot-com crash, seeing the financial crisis, seeing all these things. You see enough of these cycles and you watch the way that people behave. And again, it's not going to help your client. I guess you kind of know what you're getting into when you bring on a new client, and you kind of set expectations at that point, hands on, hands off. I like to introduce options to people as a tool, a way to enhance income, not produce more risk, or a way to protect. I think maybe sometimes that resonates when I get calls from family members or friends about what they should do. But again, they have to understand the risk, what options are and so forth. But those can be great tools for people to really want to take the time to understand whether it's, I don't want to buy that stock here, but I'll sell downside puts, or I would sell the stock if we got up another 10%. Well, write upside cover calls. Like, I'm sure you sound like a smart guy. I'm sure you're aware of that, but there's things like that you can just try to enhance, and some get it and some don't. But I found that 99% of the time, it's a losing game. So as far as trying to convince people anything else other than what's right in front of them. So
Yeah, no, I'll add to that real quick because this hits kind of personally for me. So first of all, I always use this line that the best way to avoid a drawdown is after one's already taken place. Right, that's just a fact, right? Because it's like if you're going into the drawdown, well, you've missed it, so then you're probably fine. But the other part of this is, and I've lived this as somebody again who's an entrepreneur, and it was doing well because it was risk off in advance of the COVID crash, avoided the entire thing, and closed the year up so strongly. People got it. They understood treasuries are the risk off asset. Oh, it makes sense. Now, if I say the exact same narrative today, nobody gets it. So the argument is that people don't change, and people's understanding of markets is a function of a chart, even though and the direction of the chart. And that's a really, whether you're an advisor or you're managing products that's mark to market daily, that is brutal and almost impossible to counter. And that's why I keep going back to that line. Sometimes when you're in these periods, it's not really about trying to overly communicate. It's just about waiting it out and hoping that you're around long enough to see the other side of it. I mean, that's just, I think, the
yeah,
nature
let
of
me just say
markets.
on the question about behavioral finance, understanding what's priced into a stock or what's priced into an investor community, what's not. Going the other way when everybody hates something, it's hard to do. And I don't know if you can teach it as much as you can just raise your antennas and try to recognize it. And listen, it doesn't always work. It takes a long time to work, but we all know when your 18-year-old comes and tell me that they created some token. My son, I don't even know what he was talking about. I was like, when I heard that, it was like 9 months ago. I'm like, well, that's it for that. Wrap it up, everyone in crypto, because it's over now. But my point is that, like, the old shoe shine adage, the old taxi cab driver, the old stuff. Yeah, it sounds stupid, but it's meaningful on what everybody is doing. Everyone knew it was trading the housing market. Forget about trading the housing market. But it saw the housing market in 2004 and 5 and 6. that friends of theirs, of mine, of people that really were kind of lost in life, all of a sudden they own 3 homes and they've turned into a contractor and they're doing that. That's not hard to figure out that that's going to go wrong when something doesn't make sense, right? When you just recognize that when something's too good to be true in life, that's normally true, but in the stock world, it's pretty much always true. And that could be, by the way, it's not just owning stocks. It's about stocks that are beaten up. Everybody hates something, you buy it, right? I mean, so anyway, there is an investor psychology that is out there, and that's the part I miss most about high touch trading. We talked about, at the start of this thing, and really understanding that you get a better feel for kind of what's out there. You're playing online poker versus poker at a table, to a degree with what's going on in the algorithmic trading world. So anyway.
Sometimes you do feel like you're taking crazy pills, like when you see the kind of things that people are saying. And I see this, you see it especially on Twitter, just the way people frame things and the way they outright insult you and not your arguments. Never mind the fact that when you're running public funds, you can't even respond to criticisms around your funds from a compliance perspective. But it is, while you're joking about it, it is really difficult to stay true to yourself when you see everybody else that has nowhere near a fraction of your experience, knowledge, work ethic. And I'm not just saying, me or Danny. I'm saying just as a general statement. It's really hard to stay sane in those periods. I mean, don't underestimate the difficulty of managing yourself in an insane world. I think,
Yeah,
Danny. I mean, I'm sure you've seen that many times yourself too.
yeah, the market can remain irrational longer than you can remain solvent. I mean, that's what you're saying is true, and you start to doubt. I've actually had moments in time where I look at a stock, I'm like, I go through every, like, if I'm shorted, I go through every bullish argument. Like, what am I missing? Please, and I look and I want to find it. I want to find that I'm wrong. Not that I'm going to be right, but I want to find the points that I'm looking at that I know are going to be the long term drivers that are going to move the stock in the direction that I think it's going to be, whether it's long or short. And it can be there's long stocks. We call those value traps. Long stock, going long a stock that doesn't work, that no one seems to care. I mean, you can have two companies that are in the same industry with the same earnings, same revenue, and they trade 30% apart on price earnings or cash flow multiples. And the various explanations you would get for, maybe that management team is better stewards of capital, right? Over time, they're going to issue a dividend and buy back stock, whatever. But eventually, over time, if you can get past that and have long duration, again, I'll talk about on the long side, since everyone tags me as a short seller, it's just as powerful. And those moves on the long side, you've gotten a glimpse of that in energy. You want to see a microcosm of behavioral finance 101, over bearishness, ignoring fundamentals, now holding your nose and starting to dip their toe in. Do you realize if energy prices stay where they are, how undervalued? And I'm not even long a lot of energy. I'm just stating in general. You think anyone's taken the time to plug in their models if oil, now you go out on the curve in the futures market where oil is actually trading right now, what that means? These things are trading at 0.5 times EBITDA. They're trading at 2 times earnings. So anyway, my point is that when everybody hates something, run to it and find out, why does everybody hate something, a sector, a stock, whatever. But anyway, it's very frustrating. But therein lies the opportunity. So yeah, listen, there's going to be people that are never coming back, or will come back when they're later in life, at a different stage of their life. The average age of the Robinhood trader a year and a half ago was 31. That was the average age, which means that they're 13 years before that, all they knew was the Fed having their back on average, right? So there's a whole group of investors that never should have come in here. Yeah, anyone should be able to invest. I think every person should have access to the markets and all that, but unfortunately we will lose some. But that's no different than any other cycle. You think about the global financial crisis, forget about stocks. There's a generation of people that will never trust banks, right? This isn't just about the stock market. This is going to be about, I don't trust the system, and I'm blaming short sellers and this, that, and the other. I mean, it is violent out there, in the market. So unfortunately, the answer is yes. But also, it's self-fulfilling that the people that recognize that it's not too late, or recognize that, what, this was a bet, I was gambling, this is wrong, they will be in the markets, and they will. And hopefully, you learn a lot when you lose money, right? It's to me, it's a knowledge opportunity. And I always look back, what was wrong about that trade? Was it the timing? Was it how I was viewing it? And hopefully, people can take away something from this debacle and understand Michael's point. When you hear the word 60-40 portfolios, a lot of people probably don't know what that means, but historically allocators have been 60% equity, 40% bonds. And when they both go down, yields move higher and stuff. That's the dangerous situation that we're in right now. I think people are confused. And I know we're about to wrap this up, but I think one of the biggest problems has been passive investing growth over the course of the years, a false sense of security, fixed income ETFs, which I think, Michael, have exacerbated the volatility in yields, right?
100%. Yeah,
So
100%.
there's a lot in there in the plumbing. So we will lose people, we'll gain people. There's a whole generation coming up. Hopefully that we'll only know an S&P. Well, I hope I'm wrong at 3,000. Maybe hope that doesn't happen, but if it does, it'll be a bull market of the next generation. So we're always going to have these markets. So you just got to learn how to thrive and survive if you can. So
Yeah, as Charles Dow once said, right, the one fact pertaining to all conditions is that they will change. So you're going to lose people, you'll gain people, but the only thing you can count on is that things are going to look different. So I think that's a good way to wrap it up. So again, everybody that's here, make sure you follow Danny Moses. Thank you, Danny. Really, this was a fantastic conversation for the hour. I appreciate your time,
pleasure.
your knowledge. I think that the non bullshit talk is really needed nowadays because there is a lot of bullshit out there, and it does nobody any good, including those that are saying that bullshit. Because the reality is, going back to the earlier point, it doesn't help the industry if you keep on giving people a false sense of confidence because you end up losing what are future buyers, which I think is really the key. Um,
Exactly. Happy to
so
do
thank you,
it.
everybody. Thank you, Dan.
Good luck to everybody. All right. Take care.
Good weekend. Cheers.